You have, on the one hand, inflation that's still very high, so we think central banks will deliver a round of 75 basis points in this week, and of course the ECB did so last week. But then at the same time, of course, rates now have risen quite a lot. The economy is slowing, the global economy, particularly though in Europe. And so we do think that after this round of large increases, that the major central banks will then step down again towards a 50 basis point pace in December.
Are they all in the same cycle, in the same position in the cycle? One could quite easily argue not, given the fact that you have a 2% target in Europe. You have various rates in Europe, but just going through them, 2.25 and 1.5% respective rates for refinancing, marginal lending and deposit facilities at the ECB. That is a long way from 10.7% though. Is Europe behind the curve?
Well, I think first of all the central banks are facing the same issue, which is high inflation. And so I think until now, everyone raised rates very rapidly. But we do think there are differentiations that will come out as you look forward. So in the US, the issue is essentially one of excess demand. It's a classic issue of an overheated labor market. And so we think the Fed will raise rates most. We think they will raise rates to close to 5% in March. Now, the ECB faces also high inflation, but also likely a recession. And it's predominantly a big supply shock that they have to grapple with. And I think the monetary policy response to that is somewhat different. So I think you do raise rates very quickly initially, but then as the economy weakens, I think it does make sense for the ECB to slow down. And so we think rates will go to close to 3%.
Before Juliana comes in with the more pertinent questions, I'm sure, I just want to go back into that. It's demand-led in the US, it's supply-led in Europe. I've heard that for years now, especially from European central bankers who didn't want to move for a very long time as well. Does that, in the medium term, mean that the US is going to be a much stronger economic bloc or economic nation than the EU because it has that underlying demand, which is still not apparent in Europe?
I think it's the energy shock we are seeing in Europe is likely to weigh on potential on long-run output in Europe, because energy costs are likely to stay higher for a longer period of time, and that will weigh on economic performance, I think. So, for example, when you take our economic forecast since the start of the war in Ukraine, we have downgraded our long-term forecast for Europe between 3 and 4% on the level of real GDP. And I think that signals the cost effectively of permanently higher energy prices. And the US, of course, doesn't face that to the same extent because gas prices in particular haven't gone up nearly as much in the US.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.